Good morning and welcome back to Almus Market Mornings. As we end the week, we once again face a scenario where the broader sentiment on risk remains weak. The rise in energy prices is once again concerning, with Brent at $100 per barrel. Broader AI-driven narrative once again facing question on what returns such large capexes will generate. And of course, the older element of tariffs once again coming back into the center stage. The geopolitics is not even limited to what's happening in the Middle East. Energy analysts are also watching the attacks on the Caspian Sea pipeline on the Russia's Black Sea coast. This exports most of Kazakhstan's crude. All of this is coming at a time where energy inventories across the world is quite depleted. Good morning, JK. Another weekend upcoming. What are you taking away from this week, and what narrative will drive the markets going forward?
Morning, Swaraj. I think we are overwhelmed with news from geopolitics, and really that has become the main driver on the markets, and everything else is of secondary importance now. And yesterday's, statements from Trump that Iran does not, Iran is not coming forward for a mediation effort, added to the tensions in the market, moving up the prices. And there are reportedly US is actually seriously considering a massive attack on Iran. This is according to some analysts, because they have reportedly deployed additional special operations forces to the Middle East, repositioned the fighter aircraft, sent more than 150 additional, medics to the regional medical center in Germany. Germany serves as the primary U.S. military trauma hospital where seriously injured personnel are treated before being flown to the U.S. Substantial naval presence is also being maintained. So earlier, instances where there has been such military buildup has actually ultimately been followed by actual military action, suggesting that this latest deployment is also expanding Trump's options rather than signaling restraint. So, whatever the hopes that people were having about peace between Iran and US, so that's really dwindling and tensions are rising. So, no surprise that oil prices crossed 100 on the Brent, now at nearly 101 now, and doesn't look like changing the course right now, and that's driving everything else. Of course, you also mentioned about the attacks on the Caspian Sea, which serves not only as the route through which the Kazakhstan's oil is exported, one more, stumbling block for the oil supplies, but it's also a route used for military and logistics of cooperation between Iran and Russia. So it could be related to the Iran US standoff also. So nothing is looking good. We are seeing the oil price driving everything else in the market. In fact, as if it would matter, the Republican-led House also passed a legislation directing the President Donald Trump to halt the US military action against Iran and withdraw all the forces from them. But this has no meaning, because even the earlier similar moves were ignored, and US has continued its war. So no relief. Yields on the US Treasuries climbed to fresh highs yesterday. 2-year touching 4.37%, last seen in February 2025. 10-year at 4.71, not long ago. 4.50 was serving as a resistance, and 30-year is at 5.19%, clearly above 5%, which was seen as a resistance and top push for the yields. And this was also helped by a big drop in the initial jobless claims, the weekly number, which gives a sense that the economy is also still doing quite strong. So we have seen the not only the Brent crossing 100, but also the WTI, also touching 93.50, moving towards 95, which is considered as again a big level, for oil. We had the ECB rate decision yesterday, which was, of course, I would say, in the current scheme of things, a sideshow, but still, because the monetary policy implication, on the yields in the market, that was being watched. And Lagarde, ECB president, acknowledged that the governing council favored an immediate hike, highlighting the risk of gas prices rising and Europe's tight storage situation. But considering that the inflation risks are now skewed to the upside, but looks like September is the default outcome for next rate move by Europe. Market discount 71% chance of a rate hike from ECB in September. Of course, it is surprising that ECB not acting. This meeting is seen as negative and euro is pushed lower while US has been dilly-dallying on rates for more than a year, despite high inflation, which is now actually nearing the double of their target at 2%. Stock markets took the developments on their chin. Google and Tesla results were pointed as triggers, but then I feel the oil price rise, yields rising, and in the background of large capex related borrowing from the big companies, big tech companies is also another reason, because the money is getting costlier. We all already highlighted yesterday how the US huge borrowing by US is also pushing the yields up in the long-term treasuries. Now, the 2-year yield now trading above 4.35%, which is more than 0.5% above the Fed fund rate at 3.75%. So, market is actually pricing in 2 rate hikes by the Fed. So, not good news. Obviously, dollar gets big support because of this, and euro broke the 1.14, which it was holding, but still that 1.1350 support is not broken. Euro is a very slow mover, either way. So it's a very highly traded and liquid currency with interest on both sides at any given point of time. So market is still not very sure about wholesale selling of the euros, because eventually all these developments also are negative for the US economy, particularly the US yields going up. So market is going in a measured way. Interestingly, on the yen, which is almost as 164 now. So not long ago, when Japan intervened, spending as much as $70 billion, to bring down the dollar yen, went down to just around 156, and then now we are back at 164. So that shows the impact of the intervention on markets and how big the market is relative to what the central bank can do. Interestingly, yesterday, US Treasury Department said yen weakness has persisted despite narrowing interest rate differential, and volatility in the currency was not desirable. US Treasury will continue its consultations with the Japanese ministry, etc., just giving some support to the yen. But still, I think we are not seeing any action actually on the currencies. So yen continues to be weak. Overall, dollar strong. We're trading at 101.50 right now. Even the gold and silver, which had rallied the last few days, have been pressured down with yields going up massively. On the rupee, for most of the session, or I think the whole session, we stayed traded below 96.50, but the floodgates got opened after the close of business on onshore trade, as the rupee slumped to 96.80 in the NDF market, reacting to steep rise in the oil prices that is touching 100. If oil prices remain elevated, the specter of stagflation in India, high inflation with slow growth, apart from current account deficit rising further towards 2%, all these will come into play. So as we have been mentioning, RBI's limited firepower relative to what it was a year back on intervention is also another thing that the market would be aware of. So there is some vulnerability on the rupee. As we mentioned yesterday, 96.70 has been seen in onshore market, and there will be an attempt to go towards 97, which is the all-time high. Again, the focus is on what the central bank will do, whether there will be intervention plus some policy moves. There's something that we need to see, because the currency weakening, along with the prospect of higher oil prices and inflation, is not something that the policymakers would be able to put up with. So there can be some serious action even on the policy front. So that is what I feel. So all in all, I think we are ending the week on a very somber note. not really encouraging anywhere. Stocks in the Asian markets are also down, along with the Indian markets, which are already showing some 200 points negative on the Nifty. So hopefully some positive news emerges, because this is not helping, and the situation is not helpful for anyone, neither the US nor the other countries, as well as Iran. So it's only some hope that by the weekend something positive develops. Otherwise, most of the negatives are already in place. Thank you.
Thank you, JK. And yes, a higher rate scenario along with the geopolitical concerns that's ongoing, that's a narrative we have been discussing for the large parts of this week. Going into the weekend, we are in a scenario where it seems that US is preparing for a very big attack on Iran because there's a lot of forces built up. And previously, whenever we have seen such kind of actions, they have always preceded large attacks. Uh, so maybe there may be something that happens this weekend or in the coming few days. More or less, yields are higher, dollar index is stronger. Rupee, of course, weakening substantially, gradually as of now in the onshore market. But yeah, we'll get to know after today's opening how things pan out. But it looks like we are all set to test the all-time lows for the rupee. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh. We'll catch up on Monday with a fresh round of updates. Have a great week.